There's a specific kind of broke that doesn't look broke. The salary is 6 figures. The job title makes other people pause when they hear it. The apartment has a view. The car has heated seats. The credit card is platinum. And yet, if the paycheck stopped tomorrow, the entire structure would collapse in about 6 weeks. That's not poverty. That's not bad luck. That's a financial psychology that high income makes invisible. Today we're breaking down the 5 mechanisms that keep high earners broke, and why making more money often makes the problem worse, not better. Welcome back to Max Sense, the channel where we look at money the way it actually behaves, not the way the brochures describe it. Today's data comes from the Federal Reserve, the Census Bureau, and peer-reviewed economics papers. No gurus, no motivational posters, no just stop buying lattes. Just the actual mechanisms and what to do about them. Here's the paradox almost nobody talks about. Between 2019 and 2022, real income rose about 3%. Real net worth rose about 37%. Which sounds great until you realize that gap is exactly the problem. Income tells you what's coming in. Wealth tells you what stayed. Income is flow. Wealth is what remains when the flow stops. Most high earners measure their financial health by the flow, the thing moving through them, not the thing that stayed. And flow without stock is just a river, impressive while it runs, gone when it doesn't. The median American household has about $191,000 in net worth. The bottom 10% has zero or negative net worth, and 42% of households carry credit card debt. Those numbers don't only describe people you might call low income, they describe a lot of people earning a lot of money. Because once you understand the mechanisms, you stop being surprised that high earners end up here. 5 of them. Let's go. The flow feels like the whole picture. It moves through your account every month, pays the bills, but the stock is silent. It doesn't announce itself. You have to go looking for it, and most people never do. Here's the practical result. 2 people can have identical incomes and completely different financial realities. One has been building stock. The other has been consuming flow. From the outside, they look the same. Mechanism 1. The flow versus stock confusion. Here's the part almost nobody catches. In economics, flow and stock are different things. Flow is rate over time. Stock is what exists at a single moment. Income is flow. It only exists while it's moving. Wealth is stock. It exists whether anything is moving or not. Most people know exactly what their flow is. They can tell you their salary to the dollar, their monthly take-home to the cent. Ask them their liquid net worth, the stock, and they pause. They approximate. They include things that aren't actually liquid. That pause is the whole problem. Most people feel their finances through the flow. The paycheck hits, the bills auto-pay, the 401k auto-contributes. And because the flow feels stable, the stock feels irrelevant. Everything runs automatically. Direct deposit, auto-pay, auto-invest. It feels like a system that can't break. Systems break. The word stable is doing a lot of work here. Stable flow isn't the same as financial stability. Stability means surviving an interruption. Flow stability just means the interruption hasn't happened yet. Think about what the autopilot actually does. Keeps the plane level until the engine stops. When income stops, the automated system doesn't slow down gracefully. It hits a wall at full speed. Picture someone earning $95,000. Mortgage auto-pays. 401k auto-contributes 6%. Insurance auto-deducts. They feel stable. Then on a Tuesday, the layoff email arrives. And here's what the stock actually looks like. The house can't be sold in a week. The 401k has a 10% penalty plus taxes. The checking account has $2,000. That's not the flow they were used to feeling. That's the stock they never bothered to look at. The mortgage doesn't pause. The insurance doesn't pause. The subscriptions don't pause. Everything that felt like a system reveals itself as a series of obligations, all due on the same day. This is why liquid net worth isn't optional. It's the only thing that buys you time when the flow stops. 10% penalty, plus ordinary income tax on the withdrawal. In a middle bracket, that's roughly 30% gone before the money reaches your account. $50,000 in a 401k early withdrawal can cost $15,000 to access. The emergency just got 30% more expensive. The Fed data shows it clearly. Income barely moved in real terms. Net worth jumped, mostly through asset prices and home equity, which sounds good, until you remember that home equity doesn't pay your rent in another city. Illiquid wealth feels like wealth. It just doesn't act like wealth when you need it to. Total net worth feels good. Liquid net worth is the number that shows up when things go wrong. Most people have never calculated the second number. They assume the first one is close enough. It isn't. The liquid number is uncomfortable for a reason. It's the one number that tells the truth about your real position. Run it once. Write it down. Then watch what happens to your financial decisions when you know the real number. So here's the fix. Once a quarter, calculate your liquid net worth, not your total net worth. Liquid, cash, checking, savings, taxable brokerage. Anything you could access in 30 days without a penalty. The 401k doesn't count. The home equity doesn't count. None of it counts until you can touch it without a penalty or a closing. That number, the liquid one, is the only honest answer to where you actually stand. Mechanism 2. Mental pre-spending. And this is where the standard explanation breaks down. The usual story is that high earners spend more because they have more. That's not wrong. But it's not the mechanism. The mechanism is that anticipated income feels psychologically real before it's financially real. In 1988, economists Shefrin and Richard Thaler showed something specific. People mentally separate money into different accounts. Current income, current assets, future income, and they apply different spending rules to each one. The dollar is the same. The mental category isn't. Mental accounting is why lottery winners spend their winnings differently than salary earners spend wages. The brain assigns rules to money based on where it came from, not what it's worth. Future income is the dangerous category, because the brain treats it as already available. The moment the promotion is confirmed, the apartment search starts. Not because the money arrived, because it feels like it arrived. Here's the scenario. Promotion confirmed in March. Effective in June. By April, she's looking at apartments in a better neighborhood. By May, she's signed a new lease. The new rent is $1,400 more per month, but the raise hasn't hit yet. So for 10 weeks, she's paying the new lifestyle on the old salary, which feels like a small detail. It isn't, because the gap gets filled with credit. And the new baseline doesn't reset when the raise arrives, it becomes permanent. The raise was supposed to close the gap. Instead, the gap expanded the lifestyle. The raise just paid for what she'd already committed to. Anticipated future income is psychologically available. Financially, it doesn't exist yet. The raise eventually arrives. But by then, the lifestyle has already absorbed it. And now she needs the next raise just to feel neutral. The treadmill got faster, and she didn't notice stepping on it. This is the part of money psychology people don't want to hear. Future income doesn't exist. Until the deposit clears, it's a promise. And promises don't pay credit card interest. The offer letter doesn't pay the landlord. The promotion email doesn't cover the car payment. Only deposits count. Promotions get rescinded. Companies restructure. Job offers get pulled. It happens more than people expect. The 90-day rule also guards against a subtler trap. Excitement distorts judgment. The lifestyle you commit to in a good mood is often bigger than the one you choose with a clear head. Excitement distorts. Deposits don't. Let the money arrive first, then decide from reality, not anticipation. The fix is mechanical. No new lease, no new car, no new subscriptions before 90 days of deposits at the new income level. 90 days. Not the offer letter. Not the promotion email. Deposits. The 90-day rule isn't pessimism. It's the minimum time needed to verify that the income is real and stable. 3 paychecks at the new level. Then adjust. Not before, after. Mechanism 3. Invisible budget creep. Now here's the detail that makes this dangerous. Most lifestyle inflation isn't one decision. It's 100 small adjustments, none of which feel like a decision. No single line item looks alarming. The gym is $50 more. The grocery store is $100 more. The neighborhood is 600 more. The grocery store gets a little nicer. The gym gets a little better. The neighborhood gets a little more central. Nobody buys a yacht. The new baseline just keeps moving quietly in $5 and $50 increments. Each individual upgrade feels completely reasonable. That's the mechanism. It's not greed, it's normalization. Each new level becomes the new floor. The dangerous part of budget creep isn't the spending. It's that the spending resets what normal means. Once a level becomes normal, going back doesn't feel like saving. It feels like deprivation. That psychological asymmetry makes budget creep almost self-sealing. The new floor becomes the floor. In 2011, economist Heffetz published a paper showing something specific. Visible categories, the things other people see, scale more steeply with income than invisible ones. Restaurants, clothing, cars, neighborhoods. These respond to income. Utilities and insurance, oddly, don't respond as much, which tells you something about what the spending is actually for. Spending goes up where it's visible, not where it's useful. That's not a coincidence. It's a pattern in the data. Here's what that looks like in real numbers. The top 10% of households earn an average of $353,000 and spend about $180,000. Housing alone is $52,000. That's descriptive, not prescriptive. The point is what the categories tell you. Imagine someone going from $70,000 to $120,000 a year, a $50,000 raise. New neighborhood, $600 more in rent. Better gym, $50 more. Restaurants 2 nights a week instead of 1, about $200 more. A few new subscriptions because they're only $10 each. Another $80 a month. Add it up. $12,000 a year. None of it felt like a decision. And the raise, the entire $50,000, has been absorbed by the time she does her taxes. She didn't get richer. She just got more expensive. The savings rate didn't move. The lifestyle absorbed the entire delta. That's invisible budget creep. It doesn't announce itself. No alarm goes off when the baseline shifts. There's no notification. The number just moves quietly, permanently. Decided spending compounds your wealth. Drifted spending compounds your baseline. Only one works in your favor. The audit isn't about guilt. It's about closing the gap between the life you're building and the one building itself around you. The fix is uncomfortable. After any income jump, audit your spending categories by category every month for the first 6 months. Not your total. The deltas. Where did each line go up, and did you choose that or did it just happen? Which is why auditing category deltas right after a raise is the only effective intervention point. Later, the spending is already normalized. Earlier, you can still see the delta before it becomes invisible. The question to ask for each category is not, do I spend this? It's, did I decide to spend this? 3 categories. Find the ones that moved most since your last raise. Decision or drift. Mechanism 4. The wealthy hand-to-mouth trap. This is the one that surprises people the most. There's a category of person economists call wealthy hand-to-mouth. They have substantial assets. They also have almost no cash. On a net worth statement, they look fine. On a cash flow statement, they're one bad month from a crisis. Kaplan-Violante-Weidner found that about 1 in 3 U.S. households is hand-to-mouth. And about 2/3 of those hand-to-mouth households actually hold substantial illiquid assets. Translation: they're rich on paper. They're broke in their checking account. Picture the balance sheet. Home equity $180,000. 401k $60,000. Checking $3,000. On paper, that's $250,000. In practice, none of it pays this month's groceries. There's a specific psychology behind the wealthy hand-to-mouth pattern. It's not carelessness. It's optimization. Every dollar in a high-yield asset earns more than a dollar sitting in savings. That logic is mathematically correct. It's strategically wrong because it ignores liquidity risk. The wealth is real. The access isn't. And in a financial emergency, access is the only thing that matters. Liquidity risk isn't about yield. It's about what happens when you need cash on a timeline you didn't choose. You don't get to negotiate with a job loss. You don't get to schedule a medical emergency. Then comes the unexpected. A layoff, a medical bill, a repair that can't wait. And the only liquid options are the worst ones. Credit card at 24%. For 401k withdrawal with a 10% penalty plus taxes. Pulling $50,000 from a 401k early can cost roughly $15,000 in penalty and taxes alone. Depending on the bracket, sometimes more. Which means the emergency just became 30% more expensive than the emergency. Here's the trap underneath the trap. Because the assets exist, the brain treats the emergency fund as redundant. Why hold cash earning 4% when the house earns 6%? The math looks right. The logic is wrong. Yield is irrelevant if you can't access the asset when you need it. The answer is that the house can't pay your COBRA premium in week 3 of unemployment. The 401k can't either. Liquidity isn't a yield problem. It's a survival problem. The Fed has reported that only about 6 in 10 adults could cover a $400 emergency expense using cash. Only about 55% of adults have 3 months of savings set aside. A $400 emergency, not a job loss, not a medical crisis. For $100. That number includes a lot of people whose pay stub would make you assume otherwise. Wealthy hand-to-mouth isn't a failure of income. It's a failure of allocation. High earners can afford to build liquidity. Many just don't because the assets feel like they're doing the job. Liquidity is insurance. And like all insurance, it costs something to hold and everything not to have. A liquid buffer isn't a drag on returns. It's what lets you keep all other positions intact when life doesn't go to plan. Without liquidity, every financial shock forces a bad decision. With it, most shocks are just inconvenient. The fix. Total net worth and liquid net worth are 2 different numbers. Track them separately. Your emergency fund only counts the second one. Home equity isn't a buffer. It's a bet that you'll never need to move fast. Mechanism 5. Identity anchoring. This is the deepest one. But here's the part almost nobody catches. Most high earners don't think of themselves as people who earn this much. They think of themselves as this kind of person. And that identity comes with a set of implied commitments. The neighborhood, the car, the wardrobe, the restaurateur, the gym. George Akerlof and Rachel Kranton in the year 2000 made the argument formal. Identity is part of the utility function. Acting in line with your self-concept is itself a payoff, which means a financial decision isn't just a math problem. It's also an identity question. Identity anchoring is the reason people know intellectually what they should do and still don't do it. The math is not the problem. Most high earners can run the numbers. They've run them. The problem is that the correct financial move conflicts with the person they believe themselves to be. And when identity and math conflict, identity usually wins. Not because people are irrational, because the cost of the identity violation feels real. Picture this. Someone considers moving to a similar apartment $400 cheaper. Same square footage. Different neighborhood. $400 a month is $4,800 a year. Over a decade, almost $50,000. They don't move. Not because the math was wrong. Because the address is part of who they are. The neighbors look the part. The colleagues, the dates, the friends, they all know this version of the person. Downgrading the apartment means renegotiating the identity. And that renegotiation feels like loss. Even when the math says it's a gain. And here's the part that makes it sticky. Research by Tella and colleagues suggests adaptation to income happens faster than adaptation to status. Which means the raise stops feeling good quickly. The status that came with it keeps feeling necessary for much longer. The income became ordinary. But the things the income bought became identity. That's a much harder thing to let go of. And identity isn't updated by a spreadsheet. It's updated by repeated choices over long periods of time. Which means the fix isn't a one-time decision. It's a slow re-anchoring of what signals financial success. That's a bad trade. And it's the trade most people are making without noticing. Wealth building in this frame feels like losing something. Like becoming a smaller version of yourself. But the math doesn't care about your self-concept. Compound interest doesn't ask what neighborhood you live in. The shift required is identity level. Stop being someone whose worth is measured in income. Start being someone whose worth is measured in what stays. That's the real move, not a budgeting trick. A re-anchoring of who the work is for. Net worth doesn't have an address. It doesn't have a brand. It doesn't show up at dinner. That's exactly why it's hard to build, and exactly why the people who build it have such an advantage. The identity shift doesn't happen in a day, but it starts with one reframe. What am I actually building here? The net worth builder identity has to be chosen, deliberately, repeatedly, until it becomes the new default. That's the actual work, not the spreadsheet. The repeated choice to let the number matter more than the signal. The fix is internal first. Decide what version of yourself you're building, and then let the spending answer to that, not the other way around. The people who build wealth are the ones whose identity stopped needing income to prove anything. Now you might be thinking, some people are genuinely squeezed. This isn't just psychology, and that's a fair pushback. Childcare in many U.S. cities runs over $20,000 a year per kid. Student loan payments can take a quarter of a take-home check. Housing in coastal markets eats more than economists used to consider possible. The Fed itself has documented that price shocks in essential categories have outpaced income growth for a lot of households. That's real. The structural pressure is real. And here's the important distinction. Structural pressure limits options. Psychology determines what you do within those options. Someone facing real cost pressure still makes choices about visible versus invisible spending. But structural pressure and financial psychology aren't substitutes. They coexist. The argument isn't that high earners are greedy or lazy or undeserving. It's that the same 5 mechanisms operate at every income level. High income doesn't make bad financial psychology worse. It just makes it easier to afford until it isn't. The mechanisms don't disappear under financial stress. In some cases, they intensify because the stakes are higher. Addressing both layers, structural and psychological, is more useful than choosing which one to blame. The bigger the paycheck, the longer the illusion can run before reality shows up to collect. So what do you actually do with this? 3 steps. 1 for this week, 1 for this month, 1 for this year. This week, calculate your liquid net worth. Cash, checking, savings, taxable brokerage, anything accessible in 30 days without penalty. That's your cushion. This month, pull up your last 12 months of spending. Identify the 3 categories that increased most since your last raise. Ask whether you actually decided on each one, or whether they just drifted. This year, set your savings rate as a percentage of income, not as a fixed dollar amount. Because fixed dollars get absorbed by lifestyle. Percentages travel with you when the income changes. If this way of thinking about money clicked for you, there's one book that does it better than almost anything else. The Psychology of Money by Morgan Housel. It's the clearest written explanation of why behavior beats spreadsheets in personal finance. Affiliate link in the description. The channel gets a small cut at no extra cost to you. Let's pull it all together. 1. Flow versus stock. Measure what stayed, not what passed through. 2. Mental pre-spending. Future income isn't current income. 3. Invisible budget creep. Nobody decides, it just happens. 4. The wealthy hand-to-mouth trap. Illiquid wealth isn't a buffer. 5. Identity anchoring. The math doesn't care about your self-concept. Each mechanism reinforces the others. Pre-spending creates creep. Creep creates the hand-to-mouth trap. Identity anchoring keeps all of it in place. All 5 mechanisms come back to one sentence. Income is flow. Wealth is what remains when the flow stops. And if you're someone earning well and still feeling behind, you're not bad with money. You've just been measuring the wrong number. Income tells you what you earned. Net worth tells you what you kept. Comment flow down below if this changed how you think about your income. And if you want to know why smart people make terrible money decisions, that video is right here.